Hi folks, Rob Flux here again from Property Developer Network. You'll notice that this week I have a new little friend sitting over my shoulder. So this, for those who have not met him before, is Mr. Bigglesworth. Mr. Bigglesworth was given to me as a gift from Louisa and Pat, and he's been hiding in my office for quite some time. And Louisa and Pat thought that they would give him to me because they thought I looked very good having an evil cat that I could stroke to fit in with my cunning evil plans. So Mr. Bigglesworth is going to sit pride and joy in place, I guess, moving forward for all of our Sunday sessions going forward. I can see a couple of people jumping on. So Shelley, Serena, and a couple of others. So hello, welcome to all. Wanted to say, I guess while we're waiting for a few to turn up, that we had a fantastic session on Friday night, a special one-off event in Sydney, where we had Michael Lucchetti from New South Wales Planning and Environment Department talking about the complying development codes and how they actually work. So any annual members, we're actually editing those videos and we'll be uploading that right now. If you didn't get a chance to actually go see that, then I highly encourage you to come along to that. Other than that, next weekend, we've actually got our Brisbane event, and the weekend after, we're back in Sydney again. So I guess gallivanting all around the countryside at the moment. So hi, Cam, I can see you've jumped on board as well, mate. Welcome aboard. This week, we're going to be talking about what is in a feasibility. It's one of those topics where everybody's interested in feasibilities and wanting to know, hey, can I see this feasibility spreadsheet? And they're thinking that the spreadsheet's going to do all the work, but the practical reality is the spreadsheet only captures your findings, and it's really up to you to be able to investigate the site appropriately to determine those findings, because as the expression goes, garbage in, garbage out. And if you don't know what goes into a feasibility, then you won't know what it is that you should be putting in. So I can see a couple more coming on board, Barb, Glenn, and co. So welcome aboard, folks. Greatly appreciated. Now I'm going to be talking for some time, so I'm just going to take a little sip in advance. Now, so a couple of new faces on here as well, I can see. So Paul and Glenn, I don't recall seeing yourselves there before, so welcome. As with all of our Sunday sessions, you are encouraged to ask questions. I'll do my best to answer them live as we go. Chances are a lot of the questions, I've got content for that already, but where appropriate, I'm happy to do the slight deviations. So feel free to ask questions as we go, folks. Yeah. Hi, Paul. Welcome. Now, what goes into a feasibility? So I guess a feasibility has a number of elements to it, some of which are known and guaranteed every single time, and others which are going to be very subjective and very based on the specific site at hand. What I would say is no matter what you're doing from a feasibility perspective, I'd highly encourage that you stick to one particular strategy. And by sticking to that one particular strategy, you're going to know straight away what your typical costs are going to be in a feasibility. So you can do what I call a back of the envelope feasibility. So that means how quickly can you get to the point of being able to just off the top of your head, work out whether or not you should actually put any effort into the site or not. So, so that what you really want to do is try and find a way of doing the very quick analysis that then justifies whether or not you should put a lot more detail in it. To do a full feasibility, you need to do a very detailed due diligence element, but there are elements to a feasibility that are common that you can actually determine very, very quickly within an order of magnitude as to whether or not you could or should be proceeding. So I can see Dion and Adam have joined. So Adam, hope your fight went really well yesterday, mate. For those who don't know, Adam had his first MMA fight yesterday afternoon. It was one of his goals and dreams and ambitions. So the fact that you're here, mate, means that you are alive, which is a good sign. So I can't wait to hear the stories afterwards. From a feasibility point of view, some of the ones that are fixed and known every single time, Obviously, you're going to have the purchase price of the property. That is very clear that that's something you need to add every single time. What a lot of people forget, though, are some of the little hidden costs that come with that. So stamp duty is one of those. Now, stamp duty in every single state has a slightly different calculation. So make sure that you're familiar with the calculations in your particular state as to how that happens. But it's effectively a sliding scale. So the more expensive the property, then the slightly more expensive your stamp duty is going to be. So make sure that you've factored that in into those equations. There's also legal and accounting fees. Now, the legal and accounting fees, again, somewhat overlooked because you've got legals going in and you've got legals going out. So if you're going to be doing, let's just say you're doing a 6-pack townhouse, then you are purchasing one property, but you're actually selling 6. So that's 6 lots of legal fees that you need to worry about at the tail end. And depending upon how you're selling those, you need to worry about whether or not that should be an off-the-plan type sale. So make sure you capture those costs up front. Most solicitors, when you talk to them, can do that in a fixed cost capacity, with the exception of things like searches and what they call incidentals. So if you do those searches, you'll find... so Dion says development is an MMA at times too. Absolutely, Dion. I couldn't agree more, mate. Okay, so the next thing that a lot of people forget about are holding costs. So there's your typical things, which are rates, land tax, electricity, those sorts of things. One of the ones that can be a little bit sketchy is the land tax side of things. And the reason for that is because depending upon how long the project is actually going to run, and depending upon whether or not it actually crosses over the date where land tax is calculated, then you may or may not be subject to land tax. Equally, depending upon the entity that you're holding the project in, you may or may not be subject to land tax because you may be under a threshold. So let me explain what I mean by all of that. So effectively, and the easiest way is to give a live example. Every single state is slightly different, but the general principles are fairly similar. So in Queensland, for example, the property that you own on the 31st of July is what you are assessed for a land tax perspective. So if you have a project that starts on, the 31st of June, I should say, if you have a project that starts on the 1st of July, then you did not own it on the 31st of June. So therefore, you don't have land tax at that particular point in time. So you can go, I guess, 95% of the year and not pay any land tax, or you may own the property for a single day and it just happens to be the wrong day and you will actually trigger land tax. So make sure that when you're calculating those, things that you understand exactly what your dates are and whether or not that's actually going to trigger over the assessment date. Equally, the value of the land that you are purchasing also has an impact on that land tax element. And because of that, at the entity, generally there is a threshold. So some entities have a lower threshold. If you have it in your private name, it's a higher threshold. If it's in a company or a trust, it's a lower threshold. So you may get a tax-free component of that. So the cheaper the land, the cheaper your land tax is going to be, and potentially even zero. But if you're holding it in an entity and it is quite an expensive piece of land, then chances are that's going to be quite high. So make sure you very much understand those land tax implications for your holding costs perspective. The next one that goes into feasibility is funding costs. Now, the funding costs are going to be, they're going to vary massively depending upon whether or not you're doing a small scale project and you're doing it as residential lending, or a large scale project and you're doing that as commercial lending, and you may need, I guess, development finance, which you would go through a development broker for. So you could have that very simplistically as a very low application fee if it's residential, whereas a commercial loan may be anywhere up to 3% of the cost of the borrowed funds would be the application fee. And then they have things like line fees and the like. So make sure you understand your funding costs and how you're actually going to be purchasing the property right up front. Make sure that that's actually built in. So You want to know your application fee. You want to know any valuation fees. If you're doing commercial properties, you may need a quantity surveyor. The type of valuation that you may get may be quite extensive as well if you're doing unit and townhouse type projects. Understand whether or not there's a line fee applying to that, or if it's just a plain straight interest rate. So all of those things will impact your finance costs. I can see a few more people have actually joined. So I'll just do a quick shout out to Adrian, Russell, Max, Margaret, Tendai, Dean and Michael. So welcome on board, folks. Next thing that you would want to be worrying about in your feasibility are things like your development costs. Now, your development costs are going to change for every single type of project. So whether you're doing a subdivision, whether you're doing a unit complex, whether you're doing a townhouse complex, whether you're doing a large lot land subdivision, the application fees, the consultants that you would engage will be completely different for each of those different types. Almost guaranteed, the people that you will have would be your town planner and a civil engineer. Those two are almost mandatory on everything. Depending upon what you're doing, if it's a subdivision, you may lean more on your surveyor to try and do your lot configurations. If you're doing units and townhouses, then you're going to be leaning more on your architect to come up with those conceptual plans. They're the minimum guys that need to be involved. On top of that, you may have a wide range of consultants that you may need to consider in the process. And this is going to be where your site assessment and your due diligence is going to come in, because depending upon the issue or challenge that you're trying to solve on that property, whether or not you actually need to engage those extra consultants as part of the application. So if you're on a main road, almost guaranteed you're going to need a traffic engineer. You may even need an acoustic consultant because of the fact that you've got some issues with regards to how much noise that the traffic is actually going to make on you. If you've got some environmental overlay, then chances are you're going to need an environmental report on the property. If you have acid sulfate soils, you may need some soil tests. So when you're assessing your site, looking at those overlays, looking at those constraints, understanding what those issues and challenges are going to be. As I said, the primary ones that you're absolutely going to deal with every single time are your town planner and your civil engineer, and then your surveyor and or your architect, depending upon your strategy. But there's probably 30 other consultants that you may need to have depending upon the application type that you are doing. Don't forget, as part of those development costs, you also have council application fees. Now, the application fees are just the privilege of applying to council. So that's not whether or not you get accepted, that's not whether or not it's approved, that's just for the privilege of actually lodging the application. So you need to factor that into that outcome as well. Next stage, I would think, would be, let's assume that you actually get the application approved. Then you've got some additional costs which would come into play, which would be, I guess, council contributions. Now, every state calls those slightly different. In Queensland, we call those infrastructure charges. In other states, they're just called council contributions. But effectively, that is a tax that council levy upon you for the privilege of the application being approved and executed. Now, that is generally in the form of a fixed cost per lot that is created or per new dwelling that is created. So, and how much that fixed cost is very subjective in every single jurisdiction. Some of them have it. So in Victoria, it's based on the value of the build at the end. In Queensland, it's based on, I guess, the size and type of dwelling that you're actually going to be creating, and we actually have a fixed price maximum, so it's 28,000 per lot or dwelling, and coincidentally, whilst that is the state mandated maximum, almost every single council goes very, very close to that threshold. What a coincidence, not sure how that happens. So assuming that you get those approvals, then the next thing you're going to do is looking at executing the approval that you actually got. So getting that development application to the point where it actually is constructed. Now, constructed is going to have a very wide range of determinants there depending upon what it is that you're actually executing. So if you're executing a subdivision, then your construction element is really all of the civils and the services that actually feed and water the property. Whereas if you're doing a unit or a townhouse construction project, then your execution is actually taking that through to full construct. So I'm just going to break this up into a couple of pieces. Irrespective of whether or not you're doing units or townhouses, you're still going to have a civil elements to that. So that's your water, your sewer, your stormwater, any driveways, any electricity, telecommunications, gas supplies, all of the elements that plug into the property in some way, shape, or form. So you, as I said, you feed and water that property moving forward. So they're all your civil costs. If you're doing larger lot land subdivisions, that may also include roads or potentially private roads, depending upon how you've actually broken those up. If you're doing units and townhouses, then they would be, I guess, constructing those in preparation for each of the units to actually plug into in their own right. Although usually they're, I guess, done on a little bit more bulk and scale from that perspective. So it's a slightly different design element to it. But you still need to cater for those before you can even break ground. If you're going to take it through to constructing a unit or a townhouse, or even if you're going to do some spec homes, you're going to need then to factor in some building approval costs. So you're going to go back and engage with all the consultants that you engaged with in the early phase, the architects and the engineers and that sort of thing. And effectively what you're needing to do is turn what was the development approved plans, which are effectively a two-dimensional design element on a page, and turn that into a drawing that the builder can actually build that has all of the engineering elements associated with that. So that's going to be how deep are my foundations, how big are the footings, am I going to use a waffle slab or a standard slab? Are we going to do screw piers? Are we going to do steel frames? Are we going to do wooden frames? What's the engineering level that's actually required to do this? Then we've got internal hydraulic engineers. We've got environmental consultants to say what the energy efficiency rating is, and a number of people like that. So electrical designs, where are your lights going to be? Where are your light switches going to be? Have you actually got enough light in there? What are you going to do with regards to where your air conditioning is sitting? All of those elements go into the building approval, or the BA. Now that BA will also need to consider the National Construction Code, or what was previously the BCA, or the Building Codes of Australia codes, to determine the what form and what elements need to actually go into that approval. So depending upon what you're constructing, if you're constructing a house, then that would have a Class 1A category rating. If you're constructing a rent per room type arrangement, that would be a Class 1B. If you're doing units and townhouses, then that's likely to be a Class 2 dwelling, or depending upon the size of that, that may actually be a Class 3 dwelling. So each one of those have different issues and challenges that need to go in with regards to how and where parking is, how and what you do for your fire management, how and what you do with regards to disability access, etc. So you need to understand the product you're creating right at the very, very, very start, because that then factors into your feasibility to know what it is that you're catering for at the end, because the approval process for the BA on a single house is going to be much cheaper than it is for a large unit complex, for example. So even though the element and the line item is the same, because your strategy is different, the costs associated with that are going to be different. So hopefully that makes sense. Once you've then got your building approvals and all the engineering elements, you then have your construction costs. Every single state deals with construction insurance slightly differently. So what is effectively called homeowners warranty insurance, that is the ultimate buyer who's going to own the property at the very, very end. They will be protected in case something goes wrong with the property in the future. So you're going to pay the local building board, I guess, a compulsory insurance policy, and only when that insurance policy is paid do your building approval plans actually become live and can they be constructed. At that point in time, you'll then have to worry about things like how much is your construction. I'd highly recommend that you take those out to tender to try and get good pricing on those, but then you'll be doing drawdowns for all of those payments as they put down the slabs, as they put down frames, roofing, enclosing, all of that sort of thing. So it's going to be a staggered payment system that you need to be worried about along the way. Then you've got some, I think I've already touched on this one, but you've got some authority fees and charges. So this is your council contributions and or infrastructure charges, depending upon the state. And also in not the energy authority, the utilities provider will generally have some sort of fees and charges associated with them as well. So what are called headworks charges in order to connect. I can see a couple of others have joined, so I'll just do a quick shout out to Alex and Richard as well. So a bit late onto the scene, folks, so I'm sure you can join at the tail end. Just going to take a little bit of a sip while I recharge. So at this point in time, you would think that you're getting close to the end of capturing all of your costs, but now comes the extra cost that some people actually forget about, and that is the fact that assuming you've actually finished your project, you're now needing to sell that. You need to actually account for the fact that there's going to be agents' commissions, there's going to be marketing costs. Depending upon whether or not you need to sell off the plan, the costs of your marketing and the costs of your agents' commissions may be significantly different. So if you're selling as a finished product, you may be able to get away with it anywhere from a 2 to a 2.5% interest rate for your commission. Sorry, not interest rate, commission rate. Whereas if you're selling off the plan, you may have to pay project marketing fees, which may be anywhere up to 6% or sometimes even higher of the project costs. So you need to factor that in right up front, knowing whether or not you need those pre-sales in order to get your finance approved. Make sure that you've actually got that accounted for. And your marketing costs, you may need to consider whether or not you need to do 3-dimensional renders, and how many of those 3D renders that you need to do in order to put together your marketing and sales brochures. That stuff can take some time, so make sure that you're actually working on that, I guess, as you go through the process. And then lastly, I did touch on it right at the start, but then you've got the legals for actually selling the property. And because you're selling multiple dwellings now, there's multiple lots of legals. Those legals may, if you are selling off the plan, they may have to be an off the plan contract, which is a custom contract every single time, where you actually have a disclosure statement where you're informing the end purchaser that the intended build and what it's actually going to look like. And there's some little caveat and escape clauses in there, just in case what you said you're going to build and what you actually build are not the same thing. And there's also a thing called sunset date, just in case for any reason there's some delays in the process. So those contracts are written up custom every single time. One of the things to consider when doing those custom contracts is to make sure that the terms and conditions that you've actually got in those custom contracts will not prevent any sale from actually being deemed to be a compliant pre-sale if you require pre-sales off the plan. So if you've not disclosed appropriately, you may get yourself in a pickle where the bank won't actually recognize that pre-sale. And lastly, but not least, you've now got the accounting side of things, where you now need to make sure you've covered all of your GST and BAS statements as you go. Need to wind up your company, close it down, assuming that you are going to close it down for asset protection reasons, do your final tax return, distribute out all your profits, etc. So all of those extra things need to be taken into consideration. So all of those elements go into a feasibility. So the key for you then is to actually understand, when you're looking at your property, what costs actually go into each and every one of those. Now, as I've touched on, there's a lot of dot points there, but each individual strategy is going to have a different cost for each one of those elements. So if you're only doing a small lot subdivision, then you wouldn't have to worry about things like your building approval and construction costs. If you're doing a unit and townhouse type project, then the way that you account for your civils is going to be slightly differently, because you're doing much larger sized pipes, much larger detention basins if that's what you need, etc., etc. So you will have those similar line items, but you will be accounting for them with different costs every single time. Now, one of the things that I guide our guys in doing the course is to make sure that they lock in a single strategy and get to know their costs for their particular strategy really, really well. Okay, and then when you do that, then you can actually start to get to a point where you can do, I guess, rule of thumb costs to try and actually calculate the profitability of something, to then work out whether or not it's going to be profitable, or whether or not it's even worth any more elements in the process. Russell's just raised a good point, so thank you, Russell. Don't forget your plan, sealing, and registration costs. So absolutely meant to touch on that in the closeout of the legals, to make sure that you actually get your plan, sealing, any easements that you need to be registered, etc., etc. So thank you for that reminder, Russell. That's greatly appreciated. So when you're doing a feasibility, I guess the key element is to try and because it takes so long to capture every single one of those elements for your site, you want to make sure you've captured every problem, every issue, and every challenge that you're actually going to have on that site. But that takes a lot of effort, okay? So generally, you're going to do a very detailed feasibility as part of your due diligence process. But what we want to try and do very early in the process is work out whether or not you've actually got enough profit in the deal to even bother going to that level of effort. So is it within an order of magnitude profitable before you actually go any further? So that's where knowing your numbers really well becomes quite important. And I would highly encourage that you do what is called a top-down feasibility just as your first cut when you're trying to assess a site. So by that, what I mean is, you want to understand, what is the finished product actually going to be selling for? You then need to subtract what is the profit that you need to make in order to keep the bank happy, because if you don't make a profit, then the bank will never actually lend you the money. Also, it's a great rule, if anyone's read Robert Kiyosaki, Rich Dad, Poor Dad, rule number one, pay yourself first. So if you don't subtract that profit right up front, you're going to have lots of challenges in trying to try and meet that later on. Then you start subtracting your typical costs that you would have for these projects using your rules of thumb that you've actually got whittled away. Saved away. So what your rules of thumb are, but before you've even gone to your detailed side of things. And if you from that purchase price, if you subtract the profit, if you subtract your typical costs, and before going to anything, what is unique about the property, if you can see that the amount of money that's left over is not enough to actually buy the property in the current market, then you can very quickly say, well, I'm not even going to bother going any further in the process. Sometimes you'll see that just by going through that top-down approach, that I've found sites where they would need to give me the property for free in order for me to make that profitable. Whereas when you're doing your full due diligence, you actually go the other way. You actually do a bottom-up approach. So that's where you work out the cost of the property, and then you start adding costs, and then I guess, so it's doing it in reverse, I should say. But when you add the costs, you're doing very, very detailed line-by-line items in every single instance. Whereas if you do the top-down, you sometimes you can actually, by the time you remove your infrastructure charges and you remove your finance costs and you remove your construction costs, sometimes you don't even need to finish the calculation, and you'll see that there's no money left in the deal. So it's a very quick way to actually get to the point, should I be spending any more money or any more time on this process? So that's the difference between a bottom down and a top up. The other thing to be cognizant of is, I guess, the level of accuracy of your feasibility. The only day you're ever going to know exactly what your cost of your project is the day that the project is actually finished, because there's always issues, challenges, variations, and the like that will actually come up along the way. So you need to be comfortable with the fact that your feasibility will have a little bit of slippage in it. And so you need to be cognizant of that and make sure that you've factored in a contingency that is reflective of the kind of project that you're doing, and also the, I guess, the risk element and your experience level. So if you're not very experienced at doing these, you might be wanting to have a 10% contingency, or if it's a risky project, you might want to have a 10% contingency. But as you get better and better and better at these, you might start to whittle that down to a 5% contingency, for example. Now, I can see a question here. So Belinda's asked, reverse engineer your initial FISO, right? I'm not quite sure I understand the question, Belinda, so I'll attempt to answer it. But effectively, that top-down approach is doing what I think you're referring to with reverse engineering it. Generally, when I say reverse engineering, I'm talking about reverse engineering someone else's deal. So you can actually go and look at some other deals in the area that may be similar to yours, and by a little bit of detective work, you can actually work out how much they paid, how much they sold it for. You know, some standard costs like your stamp duties and legals and things like that that are going to apply every single time. With a little bit of due diligence, you can work out who the architect was, who the town planner and the civil engineer. With a couple of phone calls, you can actually get quite accurate in reverse engineering someone else's project. You may even be able to find out who the builder is, if you've got some good detective powers, or you've got, or alternatively, if you have some things such as Cordell Connect, where you can actually work out all the engineers and consultants in the process. So that's, I guess, the core elements of it. Knowing that I've still got a little bit of content to go, but knowing that there's always a delay in the questions being asked by yourselves as you type it in and then coming up on my screen, I'd highly encourage, if you've got any questions, put them in now, and as they start to pop up, I'll see them as I go through the next part of the content. So what I would say is you want to be very cognizant, knowing what your strategy is, of some rules of thumb that you would start to apply when you're doing that bottom down type analysis, to say very quickly roughly what my order of magnitude costs are going to be on the project. So depending upon the state you're in, your legals and stamps, you may have I use a basic rule of thumb of 4.5% of the purchase price. I can very quickly subtract that every single time, even though stamp duty is actually a sliding table, and even though the legal fees are slightly different every single time, just by using that rough rule of thumb, it's not going to be accurate down to the dollar, but it's going to be close enough to the process. I also know what my strategy is, and for my strategy, me particularly, I like doing small-scale subdivisions, so very, very regularly I knock down a house, so I know my demolition costs quite well. And I know that they range very significantly based on the kind of house that it is, whether it's made out of timber, whether it's made out of brick or concrete, and whether or not it's got any asbestos in it. So I've got a price range for my home demolitions depending upon what they are. So that would range anywhere from $15,000 to $30,000, for example. And so you would then start to apply those rules of thumb. So as you go through, you would know exactly what your DA costs would be, typically knowing the kinds of engineers and consultants that you would need to engage in your process. You would know whether or not you're going to need to do a building application process, and what consultants you would need to engage in the process. You would know roughly the quality of the homes that you're trying to construct. So are they high spec, are they low spec, are they medium spec? So you would know roughly what you're trying to achieve out of those. So you're going to use all of those rules of thumb to actually apply in that top-down approach, and that will actually then help you as you just start subtracting. You'll see very quickly whether or not you're profitable. Now, I can see a question from Max. You may have already covered it, but what taxes are payable? Sales tax, GST, etc. So GST will be what applies here, Max. So absolutely, you need to factor in GST. Depending upon how your feasibility is actually put together, it's whether or not you're trying to deal with gross or net type profits. everyone does that slightly differently. 99% of the time, you would also be applying a thing called the margin scheme. And whether or not the margin scheme applies to you is dependent on whether or not you've acquired the property in the right way and whether or not you've got the right conditions within your sales contract. So rather than deviate too much from the topic, to say, yes, you could and should be covering GST in the process if you're trying to capture your net profits. But I had lumped that in previously into your accounting fees and the like. So I did mention there that you'd be paying BAS and that sort of thing along the way. But yes, you'd need to capture GST. It is not 1/11 of the sale of the purchase price if you're using margin scheme, but it really comes down to how you've acquired the property and how you've sold the property and what it is that you're actually selling. So for example, if you happen to keep the existing home because it's got some intrinsic value and you do a very minor reno and you resell that, then that's a GST exempt sale. Whereas if you knock the house down and you build something new or you sell a vacant block of land, that's a GST inclusive sale. So you need to be very cognizant of what some of those elements are. I might actually cover, I guess, tax and GST on an upcoming future one, because that can actually be quite complicated. I also note that I am not an accountant. I'm not a solicitor. Anything that I say is clearly only general guidance only. So hopefully that does help, Max. I can see a question here from Annie. So Annie says, hi, Rob. At the current market, what's the minimum profit margin you would expect when doing a FISO? Thanks. So Annie, this is probably one of the most common questions that I get across the board. And the answer that I'm going to give you is going to be quite controversial compared to what a lot of other people will tell you. And the reason is because not every project is the same. And you should not be looking at a single figure to determine whether or not that's a good deal or not. You need to be accounting for whether or not, I guess, how much time your project is actually taking for the project, and also the risk element of the project as well. So both of those should actually be factoring into it. So I'll tell you, for example, if I'm doing a project that is, you know, a 2-lot subdivision, I might be able to get that finished in 6 months or 9 months. And so the percentage profit that I want on that is obviously going to be reflective of the fact that it's only taken that 6 months or 9 month period. Whereas if you're doing a unit in a townhouse project, it's going to take 2 years. And so the profit that you're looking at of that is going to be very different. So the only way that you can really compare those is to annualize the returns. So you can compare one project against the other and take the element of time out of it and bring it to a consistent time, being annual, 12 months, to actually compare how hard your money is actually working. So and the mythical number is 20 that most people talk about. So if you get 20% profit on cost on a 2-year project, being a unit or a townhouse project, that works out annualized about 10%, okay? Whereas if I'm doing a project that takes me, let's just say 6 months, and I only get 7% return on it, annualized, that's 14%. So my money is working harder on that much smaller deal. So when I'm comparing those two projects, I guess you really need to consider that time element in it. Now, me personally, I look for a 15% annualized return. So if I'm doing a 2-year project, then I want a 30% return. Otherwise, it's not worth my while doing it. Now, everybody is different. There are many people that will actually take as low as 15% over 2 years. Personally, that's just not where I play. I just think that the risk and the return is just not worth it. So hopefully that answers that question, Annie. As I said, it is a little bit more, I guess, controversial than what most people talk about. So Max says, time adjusted profit, would you do an NPV, net present value? So the answer is that you could, Max, but you're probably overcomplicating the process. given that the timelines that our projects are taking are sub 2 years, we're not really worried too much about how inflation is impacting us and things like that. So net present value takes into a whole bunch of external factors outside of, I guess, a normal element. So I just simply annualize it. It's a much simpler, easier calculation. If, however, I was doing a 200 lot land subdivision that was going to take 8 to 10 years to roll out, then NPV would absolutely be relevant. And I would highly encourage that to be done. But where your projects are sub 2 years, it's probably just a little bit of overkill for the process. And he says, very good, you're welcome. So just saw that Baz has joined. You're a bit late in the process there, Baz, but welcome aboard, mate. You may have to rewind and watch the replay, mate. Any other questions, folks? So Max says, thanks, mate. Makes sense. Maybe only do if you do multiple stages. Yeah, pretty much, Max. The more stages you're doing, I guess the bigger the project you're doing, absolutely the time cost of money is very relevant. But under those 2 year projects, yeah, your money's turning over typically in a very similar market as well. So that's the other thing to be cognizant of. And you also need to make sure you've stress tested your FISOs as well to understand your market variations. If it's a rising tide and everything's going up in value, then you're clearly going to make more profit just because of the capital growth within the market. But if the market's going against you, then you need to factor that in as well. Now, I am not reliant on that capital growth of the market for the profit in the deal. The profit needs to stand on its own 2 feet as if there was no market movement. But I then stress test it to see whether or not, if the market goes against me by 10%, am I still going to walk away with the shirt on my back? And am I still going to be happy with the amount of profit that I make if the market goes against me? So I guess that's stress testing the FISO. That's not the FISO per se. That's just stress testing to see whether or not it's whether or not you can live with that. So Annie says, is the internal rate of return important in the FISO? So that's pretty much what I was referencing there. So NPV and IRR, I simplify both of those together into that annualized return. And very simply, Annie, I just divide the number of months of my project and then multiply it by 12 to then turn that into an annualized rate. It's a much simpler way than trying to, I guess, worry about the maths that go into an IRR or an NPV type calculation. Again, the bigger the project, the more likely that you would need to be doing that. For the type of people that are likely to be joining this call, I'm going to say most of us are looking at deals that are less than 2 years in duration. And because of that, I think those two calculations, NPV and IRR, are just probably a little bit more complex than they need to be for the outcome that you're trying to achieve. So Max has got common exit strategies. Say in a falling market, what are key milestones to cash out? So I've actually covered this, Max, in other presentations, but it's a very good topic. So you should always have more than one exit strategies in mind. And every single time you get to one of those milestones where there is an exit point, you should be reassessing to see what's happened in the market and whether or not it's the right time to get out. The other thing is you may be exiting, even though the market might be going the right way, you might have a money partner or a joint venture partner that's in the deal with you, and they may have external influences over them. They may have lost their job. They may be in poor health. They may have been hit by a bus, those sorts of things. You may have been hit by a bus. And so having multiple exit strategies means that every time you get to one of those milestones, you can actually determine whether or not now is a good time to get out based on your particular circumstances at the time. So yes, very good question. Alex says, in what situations would you use profit on costs versus profit on GRV? It comes down to the individual bank that you're applying to. Each bank will actually measure this a slightly different way. The majority of them are starting to move towards profit on costs, but there are still some that will actually do a profit on GRV, which is the gross realized value. Profit on cost, I think, is a much more consistent way of actually measuring that. It ends up being, I guess, the same profit, but the percentages look different. And equally, when you have questions like the one that came from Annie, which was, what percentage return are you looking for? It comes down to what percentage am I looking for as a profit on cost versus what percentage am I looking for versus a profit on GRV. I tend to lean towards profit on cost. Most banks are starting to lean towards profit on cost, but in my Feasos, I actually calculate both just in case the bank that I'm dealing with needs to understand that. So hopefully that helps, Alex. Coming up to the 45-minute mark, folks, and I'm seeing a dwindling number of questions come through. So I'm going to give you another minute or so to come up with a question while I take a sip. Whilst I'm waiting for those questions to come through, we've got a couple of meetups coming up in the next fortnight. So we've got one here in Brisbane, and I'm trying to remember who our presenter is. It's house relocations is the topic of the month. So if you're wondering how and what to do with regards to sliding a house on the site or relocating a house to another lot, or bringing a house onto your particular property, this will be a great one if you're based in and around Queensland. If you're not based in Queensland, if you are an annual member, you can always watch those videos as a recorded message and actually understand that. It is a very big industry here in Queensland, but I have certainly seen houses relocated in other states as well. So can actually be done, just not done as often. So Annie says, you would take cash on cash return into account too, right? I'm going to say no, Annie. And the reason for that is because cash on cash is very subjective to the individual circumstances of the person involved. So I'll give you an example that's nice and simple. So if I needed $200,000 cash to do a project that cost $1 million, and I made a $100,000 profit, then I'm getting a 50% cash on cash return. Nice, simple, easy equation. But if I did that exact same project and instead of using my 200 cash, I used a money partner and that money partner funded everything, then my cash on cash return is $0 in for that same $100,000 out, which I may have to split 50-50, but I'm getting a $50,000 return now with $0 in. So my cash on cash return is infinite. Their cash on cash return is 25%. So I guess cash on cash is a false way of measuring, because depending upon how and where those funds are coming from, can actually throw those out completely. The other variation on that is, what if I'm pulling the money out of a line of credit in order to fund that 200,000? Well, then effectively I'm pulling that out of a loan. So I've borrowed 100% of the funds, in which case the cash element is actually zero again. So cash on cash is really good at convincing an investor as to what their profit return will be. But for you, the developer, it's not a really good way to actually measure. So hopefully that explains that. Max says, thanks for your time. Got to go, family barbecue. Have a steak for me, Max. I'm definitely a carnivore, mate, so no vegetarian barbecues for me. Okay, everyone else seems to be saying thanks at this point, so I'm going to take that as a wrap and that there are no more questions. So thank you very much. I can see Chris Terrier has just joined right at the very end as I'm saying goodbye, Chris. So feel free to rewind and watch this again, mate. But we should catch up for a coffee or a beer either way. Okay, that said, folks, this Saturday, Brisbane. The following Saturday will be Sydney again. So very much looking forward to that. If you don't know how and where to come for each of those, I'll just stick the URL in. So it's www.developernetwork.com.au. If I can type .com.au/events, and that will, depending upon the state you're in, there'll be a button for every single state to try and click on in order to join that particular local community. So that said, folks, I'm going to leave that and sign off for now. So thank you very much, and see you next week. Bye.